Hello aspirants and welcome again to Legacy IS Academy. So here we continue with the economic survey series wherein we will be doing the detailed analysis of each and every chapter. So let's continue with chapter 3 of the economic survey. So here again we will look at certain important terms and definitions which has been mentioned over here in the economic survey. See, we'll be taking all the terms and definitions that are important for your exam, but here specifically those things which are not getting covered generally in the standard books, or the economic survey is coming up with new concepts and stuff. So that is what we will see here, and then we break down the entire chapter 3, that is monetary management and financial intermediation, refining the regulatory touch. So let's get started with chapter 3 and let's begin with the important terms and definition. So the very first term which the economic survey here using is the wait and see sentiment. The economic survey is saying that the consumers have, or even the entire globe is now having a wait and see sentiment. It's a very conservative sentiment. What does this mean? It basically means that because of the increased uncertainty, people do not want to take decisions. They want to wait and see how it plays out in order to increase the certainty, and only then take their decisions. So sort of a red tapeism is what you can say. As a civil servant, let's say you are not sure what to do, whether to sign the file, to reject the particular thing. So you may keep the file pending. There is a possibility. So what you are doing, you're waiting and see what happens because you're not able to take the decision. That is the wait and see sentiment. Now, throughout the economic survey, not throughout, but throughout the first chapter of the economic survey, it has compared the advanced economies with the emerging market and developing economies and the global average. So there is this concept of emerging markets and developing economies which is used by the economic survey. So what are these emerging markets and developing economies? Remember, first, India is a part of this. You have other countries like Brazil, like China, like Turkey, who are also a part of this. So what are these countries? These are nations that are transitioning from low income to higher income status. And that is characterized by rapid growth in these countries, industrialization, increasing the global integration, and the rising of the middle class. So that is the concept of emerging market and developed economies. Then let's move ahead to the chapter itself, which we will dissect in detail. So this is the very first graph you have with respect to the global equity market, gold and corporate bond performance for 2025. Now this graph may look complex, but just you have to take only certain things out of that graph. One thing that I want to tell you is, for example, gold. It has been in news. It has rallying to high points. It has reached a record high. Same is the case with silver. What I wanted to tell you here is, when the stock exchange or the stock markets are down, it is then that the gold market goes up. So generally, not every single time, but generally this is the case. Why that is the case? And that is exactly what has happened in 2025 and is happening in 26 also. However, now as we speak, the gold prices have sharply declined as well. So why does this happen? See, when the people lose the trust in the economy, when there is conflict, when there are wars, when there is uncertainty, geopolitical tensions, so people lose confidence in the market, but they have money to invest, so they would want to invest in certain things which gives them confidence, and gold and silver acts as safe havens for investment during such situations. So when these markets are down, the gold prices will be high. That is the simple logic over here. So now let us look at this. So here you can see that this is euro yield, euro bond yield, US yield is there. So if you look at this purple and green line, it is sort of falling or stable, both of them, whereas so it is not increasing from high levels, it has gone down only. And because it has gone down, as I said, what will happen to gold? It will go up. So you can see that the gold has gone up over here. So this is the most important thing that we should be looking at. Now let's move ahead to the next trends. So here these are very important trends, especially with respect to the banking system. What is this? So you have the trends in GNPAs of the SCBs. What is GNPAs? This is gross non-performing assets of the scheduled commercial banks, and this is CRAR. CRAR is basically your capital adequacy ratio. This CRAR is your capital adequacy ratio. It is also written as CAR. It is also written as CWAR. This is capital to risk weighted asset ratio also is what you call it. Now, if you look at, India had been facing a huge issue of the non-performing assets, especially in the year 2015-16 when the non-performing assets have shot up. So the first question is, what is non-performing asset? See, for a bank, loans act as assets. When you take a loan from a bank, for you the loan is a liability because you have to pay it back. But if you look at from the perspective of the bank, loan is an asset because when they give you loan, you will pay the EMI, along with it comes the interest also, which generates revenue for the bank. So loan is an asset to the bank. Now when you pay the EMI, including principal and interest both, the income is generated for the bank, correct? So in this case, this is a performing asset for the bank. But when you stop paying the EMI, what happens? This asset stops to perform for the bank. It stops to perform for the bank means it gets converted into NPA, that means non-performing asset. Right? Now there is a very objective definition of non-performing asset, that is, if on a loan, either the principal or the interest, not both, either the principal or the interest or both, any combination is possible. So if on a loan, either the interest or the principal is unpaid for 90 consecutive days, from the last due date, right? Then that loan gets converted into a non-performing asset. Now, as I said, the non-performing assets, you can see, has started to shot up, highest in 2018, which this graph shows now is under control. So let us have a look. So you have the gross non-performing asset percentage. It went up to 11.2 and now it has come down to just 2.2. If you look at the net non-performing asset, it went up to 6.0 and it came down now only 2.5. So that is really a good sign for the economy. What is this? This is the CRAR, that is capital adequacy ratio. This is nothing but the capital to the risk weighted asset ratio. So how much capital you have to address the risk weighted asset ratio? The higher this ratio, the better it is for the bank. You have to remember that. And what you can see here, that the CRAR has consistently increased. There is a slight dip over here, which you can see that there is basically a slight dip. So this keeps on increasing, right? But here there is a dip, but then again increase, there is a slight dip again. But if you compare it from this level, which was around 13 or so, now it has increased to 17.2. So this is again a good sign. All right. Now this graph is about the return on assets and return on equity of the scheduled commercial bank. So again, the higher it is, the better it is. So it was at around 11%, which went down, came negative also, but now it is at 12.5%, which is good. And this also, the return on asset has also been better now. Remember, you don't have to memorize the number. Just see that it was not constant in the last 10 years, but now it has done well and there is a slight dip over here. Now the question is, what are scheduled commercial banks? Right, so the banks can be classified into commercial banks and non-commercial banks. The commercial banks can be further classified into scheduled commercial banks and non-scheduled commercial banks. The scheduled commercial banks are those commercial banks which are mentioned in the schedule of the RBI Act of 1934, specifically in the second schedule of the RBI Act of 1934. Why they are mentioned? Because they are of significance, they have high market capitalization, they are important, that's why they are mentioned. Non-scheduled commercial banks are small in size, regional in nature, so they are as such not mentioned in the schedule. Let's move ahead and let's look at the composition of financial assets that people are having. And here the composition of annual financial savings that the people are having. There are certain changes, in fact drastic changes, that we will see over here, right? So this one talks about the composition of financial assets, compares financial year 19 to financial year 25. So if you can see this, that if you talk about the currency that is held by the people, so currency that is held by the people from 8.5%, it has declined. Currency held by the people has declined. Again, as I said, don't remember the percentage. You can simply remember the highest, which particular instrument is the highest and whether it has increased or decreased. So currency has gone down. If you look at the deposits as in fixed deposit, recurring deposit, it is the highest, but it has also gone down. Insurance and pension funds have gone up. Then you have equity and investment funds which have also gone up, and then you have this one, the debt securities, this has also gone up. So the more traditional currency deposits gone down, and equity investment, debt securities, all these investment, these are not as such too modern as such, but the banking habit of the people have increased, it can be seen. So they have gone up, and even your insurance and pension funds have gone up. So this is a really good thing. If you would have simply currency in your hand and save it in the house, it will not enter the market. So when it is entering the market, that is good. Now let us have a look at the composition of the financial savings. So if you look at financial year 12, this is blue indicates your deposit and orange indicates your shares and mutual funds. So almost 58% of your savings was in deposits and only 1.8 in mutual funds and shares. But in financial year 25, the scenario has basically changed. Now you have 35% in the deposit, so it has declined, but the shares and mutual fund is 15.2%, so there is a considerable increase in that. So people are increasingly putting their money in the market, is what we can understand from this. Let's move ahead. It is the trend in the net FPI, foreign portfolio investment, in the equity and the debt segment. Right. So now here it is, this graph is important because India is experiencing an outflow of foreign portfolio investment. That means the foreign exchange, the investment is flying away from India, and it is visible in this particular histogram. So let's look at the equity one first. So this is in 1,000 crores. So if you look at first quarter financial year 26, financial 26 means 2025 26. So you can see that equity in thousands of crores. The net means incoming or inflow and outflow, right? If inflow is more than outflow, there is a net positive. If inflow is less than outflow, then there is a net negative. So we want to have a net positive here. So let us see. So here there was a net positive of 38.7 thousand crores, right? But then in Q2, you can see there is a net negative of 76,000 crores. This net negative, however, basically has gone down here, and there is an estimate that it is going to slightly increase, but again considerably less than this. I hope that's clear. Now, if we look at the debt segment, then in the debt segment, the first quarter had a considerable negative minus 34.8 thousand crores, which we have managed to make it positive. But that positivity has declined and will further decline only. But at least we have kept it at a positive. So this actually is a big challenge for India to attract and to ensure that the money stays in India invested and it does not fly off. Okay. Next, the total amount of life and non-life insurance premiums. Now, the idea is that the government wants to ensure that there is 100% 100% insurance penetration. Now, there are two types of insurances. One is life, the other is non-life. Non-life as in the general insurance. It can be your motorcycle, car insurance, business insurance, so on and so forth. Life insurance is with respect to your, the life. In fact, the government schemes are also there. You have the Pradhan Mantri Suraksha Bima Yojana, Jeevan Jyoti. Jeevan Jyoti Yojana is your life insurance basically. So, what the survey says that the premium of both the life and the non-life premium has gone up. Premium going up means more and more people are now subscribing for life insurance and non-life insurance. So let us have a look for life's total premium for life, and then we will look at the non-life. So from 6, this is in lakh crore. So this is financial year 21. So from 6.3, it has gone up to 8.9. And if you look at the non-life one, so this also has gone up from 2.0 to 3.1. I hope that's clear. So what does this indicate? This indicates increased insurance penetration in the country, which is still quite less, but we are having a considerable improvement over here. I hope that's clear. So a lot of positives to take for the Indian economy in this case. I hope you understood all the concepts. Now ensure that you subscribe to the channel so that you are notified every time we bring any new video as such, and also you'll get the notification of all the upcoming chapters of the economic survey. Thank you.